All right, today we're diving deep into the world of high finance to figure out something pretty fascinating, a huge pay gap that exists right at the very top. We're asking, why do private equity managers so often earn way more than their counterparts at hedge funds? So, what's really going on here? I mean, both of these are incredibly well-paying fields, but the paychecks are just not in the same league. Turns out, the answer comes down to three fundamental differences in how these two worlds work, and we're going to break down every single one. Okay, so the first big reason, it all boils down to their core philosophies. It's not just about making money, it's about how you make it and for how long. You could say one's a marathon and the other is a series of sprints. It really starts with what they actually do. Private equity, or PE, is all about active ownership. They buy whole companies, get their hands dirty, improving how the business runs, and then, years down the line, they sell them. Hedge funds? Totally different game. They're traders. They're in the market every single day, buying and selling stuff like stocks and bonds that you can trade easily, trying to make money off short-term price moves. And this difference really hinges on this key concept, illiquidity. You just can't sell an entire company with the click of a mouse like you can a share of stock. And for private equity, that's not a problem. It's actually the whole point. By embracing that illiquidity, they buy themselves the time they need to make real, fundamental changes to a business. And this is why their timelines are just worlds apart. A hedge fund might hold a position for a few weeks, maybe a few months. A private equity firm, they are in it for the long haul. We're talking 5, 10, sometimes even more years. And that patience is everything. It lets them capture the value of a complete business turnaround, not just some temporary little blip in the market. All right, let's move on to our second reason, and you'll see how this builds on the first. It's the power of scale. It's not just about the strategy. The actual size and the structure of these funds play a massive role in this pay gap. I mean, just try to wrap your head around this number. The biggest PE funds are managing absolutely colossal pools of money. Tens of billions of dollars. And here's the kicker. Once an investor gives them that money, it is locked in for the entire life of the fund. That gives them an incredible amount of stability. So you might be thinking, how do they get paid while they're waiting all those years? Well, that's where the management fee comes in. It's this steady, predictable fee, usually about 2% charged on that huge locked-in pile of money. It's like the giant, reliable salary of the private equity world. And this is exactly why that stability is such a game changer for their pay. Because that PE capital is locked up for years, those management fees are super stable and predictable. Hedge funds just don't have that luxury. Their investors can usually pull money out every quarter, which makes their fee income a lot less certain, and ultimately a lot smaller. Okay, time for the third reason. And honestly, this is where the truly mind-boggling money gets made. Let's talk about the power of leverage. This is really the secret weapon that supercharges private equity returns. The main tool they use here is something called a leveraged buyout, or LBO. Put simply, it's buying a company using mostly other people's money, specifically a whole lot of debt. So here's how the magic works. A PE firm might put down only 20% of their own cash to buy a company and borrow the other 80%. Then, after years of improving the business and growing its value, they sell it. But because they only put in a small slice of the original price, their return on that small investment gets magnified, like a lot. Think about that. They get all the profit from the company's growth, but they only risked a fraction of the cost to buy it. And this is where those legendary paydays come from. It's called carried interest. It's basically their performance bonus. After the investors get their original money back, the fund managers usually get to keep a whopping 20% of all the profits. And you have to remember, that 20% isn't on just any old profit. It's on those massively amplified profits created by the LBO. It's 20% of a much bigger pie. Hedge funds, for the most part, just don't use leverage in this way to buy entire companies, so their performance fees really can't compete on that scale. Okay, so let's put all the pieces together here. How do these three things combine to create such a gigantic pay divide? Well, as we've seen, they all kind of build on each other in a really powerful way. It really is a powerful three-part combo, right? The long-term philosophy gives them the time they need to create real value. The massive scale of their funds gives them a huge, stable paycheck while they wait. And then finally, the power of leverage acts like a rocket booster, supercharging their final payout. Each step just enables the next, creating a system that is practically built for enormous paydays. So at the end of the day, the entire system is designed to reward one specific thing. As one analysis puts it, it's about private equity's ability to drive and capture long-term value creation. That intense focus on fundamentally changing a business is what the whole structure is set up to reward with a bigger payout. And that really leaves us with a pretty interesting question to think about, doesn't it? In a world that's often obsessed with what happens next quarter or the next big trade, private equity success is built on patience and control. So, what does it say about our economy when the biggest rewards go not to the fastest traders, but to the people who have the capital and the structure to play the longest game?